Thank you everybody for joining us tonight. My name is Philippe Schellegen, co-founder of Boost Capital Group. So tonight I wanted to talk about the Multifamily Business Plan 101. And I have about 25 slides. We should be done within 25 minutes or so, and then we'll have time for Q&A after that. So let's dive in. You found a deal. What are you going to do now? And the business plan is going to be a tool for you to articulate your vision of what you're going to do with that property that you're going to purchase, right? You're going to put together the different pieces to explain and present to investors this acquisition, and with the goal of raising capital. Once you have that document put together, and again, you can use that document to present to your investors, the SEC lawyer is going to attach that document to the private placement memorandum when making that private placement memorandum like a whole package. Not only describes the attributes of the deal that you're presenting or you're raising capital for, but also the business plan. For whom are you going to write the business plan? And you can take 3 points of views. There's obviously yourself, because you want a clear vision of why it's a good deal and how you're going to make money throughout the deal. It's a tool for lenders, because even though they're going to do their own due diligence, but there are a lot of questions that they're going to want to get answers about, such as how are you going to invest? Are you going to do renovations? Are you going to invest in marketing? Are you going to add units in the property? And they will want to know who are the general partners with the team and who is going to manage the day-to-day operations. And finally, and obviously, and I would say that's probably the most important factor there, is for your investors. So it's going to be the tool that you use to give confidence to the investors to invest in the deal. As an overview, already 4 main points that you need to address in that business plan. First is going to be about the team, the market, the sub-market, the property itself. Another area to cover is explain exactly how you're going to increase the net operating income, which is equal to the income you're going to collect from the rents, sometimes other income as well, and also all the expenses. And by increasing this net operating income, you're going to generate additional value for that deal. The third thing to talk about in a business plan is to talk about the deal structure from a financing and partnership standpoint. And finally, you're going to illustrate projected profit and loss as well as returns for the investors. All right. More specifically, I put like all the 16 items we're going to go over here. The first one is you want to give like an executive summary or a summary, like a one-pager. Why is this a good deal in one page? And maybe you want to talk about the opportunity. Like for instance, and by the way, the illustrations here are from past or current deals that I have. So it's all deals that I've been involved in. And so we have an example on the left, pretty simple. You're talking about what are the expectations, 10% cash on cash. Obviously, that was a deal some time ago. These days, it's much harder. And you're going to double your investment in 5 years. And why is this a good opportunity? It's very strong location, great long-term financing on that particular deal. The other illustration on the right, it's a little bit of a different format there because it's a portfolio. It's actually about an active deal that we have. I just put a little line about the projected equity multiple. And also because it's a portfolio, what we wanted to highlight there is the attributes of the portfolio. So because we have 3 assets in 3 different markets and 3 different business plans. So it's very unique proposition that we had in that case. Next, we have, and again, so obviously the sequence there is up to There's no obligation to do things that particular order. It's up to the sponsor to make that presentation how they think. But the second topic to be addressed in any case is why is the team assembled for that deal ideal? So you're going to want to talk about, give a short bio about the different team members, also talk about their track record, and additionally, usually, and I think it's a good thing, is you want to put forward the property manager, property management company, especially if they have a lot of units under management and a big shop, because they're going to have a lot of experience, obviously, and that's something you want to put forward and share with your investors and lenders. Finally, you can also mention who the lender is, who is your real estate attorney, your syndication attorney, and your CPA. It's not necessary, but always good if you need to add additional credentials to show that you have a strong team behind the deal. So next topic is, you're going to want to talk about the market. Why is this a good market? Obviously, you're going to say which market it is. You're going to talk about the population size and there's growth. And ideally, you want a pretty large market, such in the, I like the 500,000 plus, ideally 1 million people in the metropolitan statistical area. And you want to have that population that is growing as well. And you can look at the statistics, but that's for the sponsor, but you can share the statistics in the presentation. Also, you can talk about employment trends, the key employers and industries, and any major news. There's like a company, I'm looking at a deal right now, and there's this cars company building a factory in that particular town. So it's a very appealing proposition to have an asset in that town. And I showed you like two different examples, something a little more older, I think, in terms of how we present things, and less colorful about Birmingham. But you can see there's information about job growth, the population growth, and some other features such as affordability and low taxes. The other example is about the Atlanta market. And obviously, being a large market, there are a lot of information, number one, number two, and all these statistics that you can share, as well as the key employers you can see on the right of that particular illustration on the bottom left here. Next, you want to talk about the submarket, and I apologize for the overlap there. Why is this submarket attractive compared to the rest of the market? And again, it's the same approach there. You're going to talk about the key employers, key businesses and attractions, stores and whatnot. But more, instead of looking at the big picture of the whole market, you're going to be looking at a more specific area. Also, depending, and particularly if you do Class A, Class B, you want to take a look at schools, because good schools will attract quality tenants. And you can give information about the average household income, because you want to check that and I mentioned average, it should be median, but you want to make sure that this particular market is going to support the rents. And for a good filter for rents, for instance, is going to be that you have 3 times the yearly rent that is lower than the median household income. So you want people to be able to afford to pay the rent, right? They have obviously additional income to pay for other necessities. Another interesting information, and you're going to want to start characterizing a little bit your tenants. How many jobs in that submarket? Is it like white collar jobs or blue collar jobs? Again, if you're doing Class C, which is more like for workforce housing, you're going to want to have a lot of blue collar jobs, obviously. Class B could be a mix. Class A typically is going to be white collar jobs. So next we're going to talk about the property itself, right? So what are the characteristics of that property? So the class, I just mentioned some examples, Class A, B, C. The number of units, of course, the floor plan breakdown, how many 1 bedroom, 2 bedroom, etc. The unit size, the occupancy. Is this a stable deal or is this mostly vacant? And like the financing terms will be different depending on what kind of occupancy you have and distress you have in the property. Typically, above 90% full occupancy is considered stable, and then you have more options to finance your deal. Your build, it's important to know about your build. Older properties, there will be more maintenance or required, or you need to make sure that there was sufficient capital spent by prior owners to the property. So you may end up with an older property, but if it was well maintained, it's not necessarily a problem. You want to know about the amenities. Is there a pool? Is there a washer and dryer in every room? Is there a playground? Assigned parking, covered parking? I know in some of the hot states, they have some of those covered parking in Arizona, for instance, etc. Then what are the current rents? How is the property performing, right? And how you're going to compare that property in terms of occupancy, rents, and sale price to other properties nearby. So again, some illustrations. Here we have an example. Obviously, you want to promote best-in-class amenities, so that would be for Class A property in that case, and luxury interiors. That's on the top of there. Then you have the example of the floor plans, the breakdown, and maybe you can put a little picture or a drawing and a pie chart showing like the breakdown of the units. And finally, on the right, you have an example of rent comps. And I like these bar charts because it's very easy to see how you compare the current rents to market. And then usually could show, you say, okay, we're going to be able to target like the mid-range that the rent comps, for instance. Next topic is the income improvement. How are you going to increase your income? If you remember, I was talking about you want to increase your net operating income. So it means increasing your income and decreasing your expenses. So how do you plan to do that? And I just mentioned it, you'll be able to, with the right renovations, you'll be able to, or the right level of finishing, to bring the rents to comparable market level rents, right? So otherwise, maybe you can do additional renovations and bring the property a notch. For instance, I see there are a lot of renovations these days, depending, let's say, on a class B minus type of property. You're going to do like granite countertops in the kitchen, and it will bring the property up a notch. You can achieve even higher rents doing things. And that's true for interior renovations, that's true for exterior renovations. Also, what are you going to do to raise the occupancy to the market level? So if the market, everybody's at 95%, there are chances you can achieve that. So there's some steps you're going to take, maybe more marketing, for instance, and I believe I talk a little more about the occupancy later on. Other ideas which are more on the other income level, you have all these, if you do a bulk cable contract, a cable internet contract, then the provider will give you a cut of how many units multiplied by the plan that you're going to ask them to take. And that's something you can impose on your tenants as well. You have to take this cable contract, and as part of, anybody has to take it on the property. Pet fees, garbage pickup, preferred parking, and laundry room, storage units, vending machines. Those are just some examples of how you can increase income. Again, some examples.
This is Chris. Just a quick thing on the bulk cable and internet contract. I actually had a chance to tour a property in the Dallas area that where the sponsors actually were implementing this, and it's great for the residents, right? Because they get to have the way that it's set up is that they provide internet everywhere on the site. So no matter where they are, if they're at the pool, they can have Wi-Fi, or if they're at some other place on the property, they always have the internet connection. I thought that was a really nice amenity to have, but I just wanted to add that comment.
That's right. Yeah. Especially these days. Yeah. That would be part of, and that's something you can negotiate with the provider. Absolutely. So going back to the examples, I think what's interesting, even though I think the presentation is a little outdated, but I think it's a good statement on the top there. Like, the renovations will increase the desirability of the property. right? If there are more people interested in moving in, then you can bring the rents a little higher. And moving to the next illustration at the bottom. So here you can show like all these. So obviously it's a pretty large property there, but there will be private yards that will be set up, storage units, garages, valet trash, internet, we just discussed, amenity fee, which I'm not even sure. I don't remember exactly what it is. Sometimes you have some of these interesting fees adding up, and water and sewer fee that can be collected. And see here in that particular deal, we are generating, by implementing all these additional income topics, we're generating an additional $217,000 per year. And that would translate to $5.2 million actually on that particular deal of value. Next, renovations, right? So on the same page, along the same lines of increasing income, you have to talk about the renovations. What's your renovation plan? And what did you find when you inspected the property in terms of renovations that you have to do? Maybe there's some capex, maybe there's some roofs to change. So those are things you want to talk about in that chapter, and give like a specific list of interior and exterior things that you want to upgrade and how they compare to the submarket. Who is going to do this work? Are you going to use the property management company or use a third party to speed up maybe the renovations? Talking about speeding up, you want to share about the schedule of these renovations. We will renovate X amount of units per year and we'll do the renovations over, is it 1 year, is it 2 years or 3 years? You want to share also the budget for the total capital expenses and the target rents after renovations. Illustration here, like and I think it's certainly recommended to make that presentation as visual as possible. So you can do like some pictures before and after. Always nice to have an idea of what the sponsor has in mind in terms of renovation there. Expenses improvement, right? So how are you going to decrease expenses? Well, the first thing, is there an opportunity because maybe it's self-managed and it's not managed by a professional third-party property manager. So maybe the cost of running things is not as optimized. So that's always a potential area to save on expenses. I added the RUBS there, but I guess technically it's a mistake, should be in the income. But the RUBS is really like a way to make the tenants pay for part of the utilities when the utilities are paid by the owner. And that's, as I said, it should be in the income category. Now, if the owner is paying for water and sewer, for instance, you want to implement a water consumption reduction plan with low flow faucets and other, same thing for the toilets and showers. That's interesting. Any type of green initiative can give you access to also additional type of lending. I know there was a funny green type of loan at some point, and there are other. Actually, yesterday I heard about was a C something, but other lending grants that you could get possibly. Finally, another thing, and that happened on my second deal, we had a state tax incentive. And actually I have the whole description here. I'm not going to go over it, but sometimes if you invest, you can get a tax incentive. Again, you reduce expenses, you increase the value of the property. Typically these tax benefits, they will last for quite a bit of time. And in that particular case, it's for 10 years in the example I'm showing. And it's a great way to save money. Going a little bit deeper on the examples that I'm showing in terms of illustration in the business plan, we are going to reduce water and sewer. I mentioned that earlier. Reduce payroll, right? Because for some reason, the owner, maybe sometimes it's the case that they're just adding some extra expenses on the property, but doesn't mean that's how it operates really. And the other example is about the tax benefit that I mentioned as well. Attract and retain tenants, right? If there was a problem, maybe in occupancy, You want to talk about your plan, your marketing. You are going to do, which steps regarding marketing. Where you're going to advertise maybe on apartments.com, for instance, very popular. A lot of leads usually coming from there. Are you going to have a leasing and maintenance management improvement? How are you going to take care of that? Maybe maintenance was not great during the prior ownership. Maybe the people taking care of leasing, showing units, they were not doing a good job. So that's why, again, you come with professional management, and that will help you take care of issues of that level. Also, tenant screening. Sometimes I see these deals and they're showing 10% of the tenants with a balance in terms of what they owe on rents. And that's certainly a sign that that tenant screening was not great. And again, that's something you can improve by bringing third-party professional property management. Also, sometimes if it was an area with a little bit of higher crime, let's say, obviously try to stay away from those areas if you can, but sometimes there are good deals. You can install a gate, you can install a security system like cameras in that particular. Also, another thing that is a good idea that I heard people doing that very pretty successfully, you want to develop a sense of community and organize on a regular basis some events. Build, and it doesn't have to be extremely expensive, but you need to have somebody take care of this. It could be a barbecue, it could be just doing some activities with the children at the playground. But those things, if you can develop a sense of community, and then you have tenants who are referring the apartment complex to their friends, so now you're going to attract more tenants. Next, switching gear here quite a bit, capital stack. So you're going to want to talk about, obviously, the purchase price, your loan type, amount, interest rate, term, and amortization, your down payment, any fees, and investor equity. I have an example here. We're talking about the sources and uses. Where are you going to get your money from, and how is it going to be deployed? Is it closing costs, capex, acquisition fee, contingency, and working capital? Here an example about a loan, bridge debt in that case, non-recourse, 3 years term, and it's only at 7.27 interest rate, which on that particular deal, it was 50% occupied, a little bit distressed deal. Financial projections, right? So what is, when you underwrote the property, how the numbers came up, and how are you phasing out the target rents? What are your assumptions about vacancy? And what are the income and expenses? How does it look after you pay debt? What's the cash flow? So this is all, I know it's a little small, but it's just to give an illustration. And it's not something necessarily you're going to spend a lot of time on, but there are some investors who are interested in looking at this level of details. The structure, how the profits are shared, what kind of fees. There could be acquisition, asset management, capital event. Some people can be very creative about fees. What are the split? How are we going to split the returns? It could be 80-20, 70-30. That's the case in the example below. And is there a preferred return? Yes or no? Some people do, some people don't. There are pros and cons. Could be spend a half hour about this to go a little bit deeper. But also, is there any classes? There could be a class A, class B with different returns, and maybe class A have a fixed return, but they will be paid first, and then you have class B that is a more traditional split, etc. And then you have hurdles, which is if we achieve our goal of, let's say, 15% internal rate of return, then the split is going to change from 70-30 to 50-50, for instance, between the investors, general partners. Exit strategy. So you want to talk about how long you plan to hold the asset for. Is there any cash out refinance option that you're looking at, or is it your business plan to do a cash out refi, which it's not necessarily something I'm very comfortable with because it's hard to have visibility on interest rate down the road. It's like, how do you know? So unless you're very conservative in the interest rate with a refinance, So it's not necessarily, it's hard to implement in my opinion. What is your cap rate at exit? And which the cap rate being the net operating income divided by the purchase price. And over the years, cap rates nationwide have trended down. But now that there's a flip and interest rates went up, cap rates are turning around. What are you going to use at exit? Who knows? We can be in an environment, interest rates, they continue to go up for a while. So you want to maybe, to be conservative, add a few percentage points or decimals to your cap rate on a yearly basis. A good idea for that is 0.1% for as a starting point at least.
Hey, Philippe, just a
Yep.
quick, someone had posted a question in the chat. If you could quickly just clarify around the different split breakdown. So you had the 70-30, you had waterfalls, hurdles. If you could just touch on that briefly, I think that would help clarify.
Yeah, so the split is, I apologize if it wasn't clear. So here in the example, we're showing 70% for the limited partners, 30% for general partners. And I'm just focused on that example for now. We'll talk about the pref return after. So it means that after all expenses are paid and the debt and any potential fees, the very bottom line is going to be the cash flow. And this cash flow in that particular model, if we do 70-30, it means 70% of that cash flow will go to investors, the limited partners, and 30% will go to general partners, right? Or the sponsors or managers, they have so many different names. So an extra layer to this, and that's the case in this example, there's a preferred return. So preferred return is the amount of money that will be paid first to investors, and then the split comes after that. So if the cash flow is very above 8%, which is unseen these days, but if it's above anything above the 8%, it will be split between the investors and the general partners. But the first 8%, they would go to the investors. So that's one additional scenario. So you have the very simple would be just a split. Another level of complexity is a pref, then split. And then you can be very creative because we can combine. We can do class A is just a split and class B is just a pref, right? So that's where the classes come around. And in addition, like the fourth layer to that is the hurdles, where you have a moving target on the splits when you achieve some goals, return goals on the deal. Hopefully that clarified.
Thank you.
So going back to the exit strategy here, I was talking about the cap rate at exit that you want to mention in that business plan. And also, I think it's always if pertinent, you want to know who's the target buyer. Is it maybe a smaller deal is going to be somebody like who has with a high net worth individual wants to own real estate, right? Or is this going to be an institution who is going to buy it? Institution, they don't need necessarily like a high returns, right? And maybe they have just money to deploy if it's a large fund. Return projections. I think that's very important for the investors. If they invest $100,000, what does it mean for them? So a particular example, I know there are a lot of numbers, but the bottom line is year one, we plan projection is $3,890 return, right? Year two, you have 9,900. Then there's a refi in that particular example, and we are giving back $94,000 on a $100,000 invested. So basically at year three in that particular deal, you have more than all your money back. And then you're free flowing. You have infinite returns technically on or almost infinite returns because you have so little in the deal at that point. And you have all the different metrics such as cash on cash return, the internal rate of return, and the average annual rate of return. Interestingly enough, unique situation here, you have all these numbers that are very similar. This is very unusual example. Next,
one more
go
thing, I'm
ahead.
sorry, just can you hit on the infinite return, because when that might be a new term for some investors, and so I think helping them understand, hey, you put your money in the deal, when your money is returned back to you at some point in time in the deal, anything on top of that is gravy, as we call it, and
Yeah.
that becomes an infinite return. But do you want to expand on that a little bit more?
Yeah, because again here, like year one, if you just add the, and let me move my mouse here. You add the $9,000 plus 94, so it means all the money that you invested year one, you have collected more than that at year three after the refi, right? So your net money in the deal at that point, if you look all the cash flow that came back to you're at zero. You're already in positive. You're above. You invested 100,000. You have collected more than 100,000. So technically, any returns that you make after that date, you can consider it as an infinite return, because typically the return is, if we take the example of the first year, $3,800 divided by 100,000, it creates a cash on cash return percentage number of 3.9%. But if you divide year four, $8,700 by zero, it becomes infinite. It's because you don't have any money in the deal at that point.
Thank you.
I guess you should have said 15 here, but the acquisition schedule is, what's the timeline until closing, right? What's your closing date? What's when the paperwork will be available, the private placement memorandum, and when are you going to open the deal for investors to invest? So here again an example. The investment packet, it means the private investment memorandum, it will be available the following week after that presentation that was made. And the minimum investment is 75,000. And we expected at that point a wire the money before December 15th. I think the closing was expected or took place at the end of the year. And so here an example as well. And that's typically how it's done. First come, first serve basis, right? So we're going to say, okay, we're going to open the investment next week. First come, first serve, and then it could be a waiting list or something like that. To explain a little bit the logistics to the investors. And actually, I should have added something else. Maybe you should go to this website, this portal, sign up. You'll be able to sign the paperwork and that kind of things, more about the logistics there. Post-acquisition schedule. What can investors expect after they invested? How frequently are they going to get reports? What key performance indicators will they receive? Occupancy, income, expenses, etc. Maybe you're going to send them financial reports? It's recommended. And what's your distribution schedule? So in the example, there will be a monthly report. It's very typical to have monthly report to tell the investors how the deal is doing. Quarterly distributions, very common as well. Usually not starting right away. You usually have to be patient, wait for 6, 9, or 12 months for everything to start, especially if there's a transition with a new manager. And often there could be additional communication, could be a quarterly meeting or things of that nature. But usually the very, very typical communication would be a monthly report. So we're getting towards the end there. How are you going to write this document? It's like throughout working on the deal, you're going to be able to gather information from different sources. It could be the broker, in the offering memorandum from the real estate broker. There will be good information. The lender, they will run some inspections and underwriting report and appraisal. You have all these sources like big documents and reports that will be sent to you by the lender. A very important property resource is your property manager. They are the ones who know the best the market, what kind of rents they can get, and so on. And that's why I like to put the property manager forward in our presentations. The property manager is the one that will make or break the deal usually. And also your inspection report. Financial projections, you will do underwriting to make the illustrations that I showed earlier. for the profit and loss pro forma as well as the investor returns. All these points that I mentioned, no worry to mention all of them. You don't have to be exhaustive. You just have to pick what makes sense for the particular deal that you're going to talk about. And in terms of format, there you want a slide deck like a PowerPoint, or it could be, I know, I think my first deal we just did a simple document initially. It was like a Word document in PDF, but you want to talk about all these topics, right? And if you do a webinar about the deal, you want to show as many pictures and charts as possible to make the presentation visual, which is not the case of this particular slide. When do you write the business plan? As I just mentioned, you're going to start preparing the business plan when you first start analyzing the deal, start taking notes on all these topics that eventually you'll put together in a presentation. And you will finalize the business plan when you get ready basically to raise for the deal, and it will be towards the end of due diligence. Takeaways, it's a rich document, a lot of things. I think I certainly went over what I expected in terms of time there, but yeah, 16 main topics, a lot of things. Try to make it as easy, as readable as possible for investors. And it is a powerful tool. It will be called business plan in your PPM document, and it's a key to a successful deal. My last slide is just to give you a thank you, and we can open for Q&A. But before we do, we wanted to mention 2 free resources we have. 5 ways to boost your capital beyond your retirement account at www.boostmycapital.com/guide. And another guide, the accredited guide. Are you an accredited investor? At boostmycapital.com/accredited guide. And you can reach out to me at Philippe at boostmycapital.com.